All right, thanks to Tom and Lars for this initiative. It's great to be here. Thanks for coming. It's a joint work with Francesco and Martin. And we're going to talk about uncertainty shocks, asset supply, and asset pricing. The starting point and the main motivation for this paper is the following set of stylized facts regarding asset supply and asset pricing. What we see in the data is that when the stock price is high, future excess returns over bonds tend to be low. Okay. This is the famous excess return predictability result. On the asset supply, we also see that when the stock price is high, the net payout to shareholders is high, and the net corporate debt increases. Okay. This is a set of stylized facts that tends to hold both at business cycle frequencies at a low frequency. So let me show you some pictures without going much in detail. But this is the value of non-financial corporate equity to GDP. So this is what we would call the equity price. And what the main message you get from here is, again, the famous result of excess volatility of prices, in which prices move by more than what the econometrician measures exposed in terms of realizations of dividends. Okay, so in particular, when price is high, future price and future measured price, future measured dividend is such that the excess return over bonds is low. Okay. Now, how does this look like in terms of frequencies? This is what this plot is showing. The yellow shades are recessions, the GDP growth on the bottom. So this evolution of equity prices has some business cycle component to it. In particular, for example, when there's a recession, prices fall. Okay? But it also has a low frequency component. You see that there are these regimes, these low frequency movements in these prices. And one that's sort of particular to the naked eye is this period of 1974-1984, in which prices are really low for a long time, for a decade. Okay, so you might think, okay, what's special about this period? Well, one dimension in which this period is kind of special, this is what the literature on great moderation insists upon, is that this period is one in which volatility of quantities, such as GDP growth, is actually high. Okay, so this is what this great moderation debate says. Well, this was an increase in volatility when you measure it as volatility of GDP growth, for example. And the reverse of that is the great moderation, in which volatility is low, and here it seems to coincide with an increase in stock prices. Okay, so here I just want to establish some of these frequency components in terms of how stock prices relate to business cycles. Now, I mentioned this set of stylized facts about on one aspect about asset prices, on the other about asset supply, so let me show you that. So here I'm plotting this net equity payout as a fraction of GDP, and this is the net change in debt. The major thing you see here is a positive correlation between this payout and debt. Okay, so in good times, in booms, payout goes up, debt goes up. In recession, payout goes down, debt goes down. Okay, so this is, again, a frequency that resembles this business cycle frequency. And it also, there is some low frequency corresponding to this also maybe this blue shades here, in which in this high volatility period, stock prices were low, payouts were low, and debt was kind of flat. Okay? So what we want to get out of this is this set of stylized facts in which in periods in which the stock price is high, payouts are high, and the debt is high. And this holds at both business cycle frequency and low frequency. So motivated by this set of stylized facts, we want to have a joint explanation for them. And in this paper, we propose uncertainty as playing a key role in trying to understand this data. Okay, so in particular, we're going to have a model in which we're going to show that when uncertainty is low, in particular uncertainty about financial conditions, when uncertainty is low, stock prices will be high because they're going to be low premia. Okay, so this is going to be able to talk about excess return predictability. Now, on the asset supply side, when this uncertainty is low, we're going to show that firms that face credit market frictions endogenously are going to choose both higher payouts and higher debt. Okay, and this is going to be able to talk about and explain this positive correlation that I showed you in this graph here between payouts and debt. Okay, so I'm going to build this model in which uncertainty is going to have these effects both on pricing and on supply. I've talked about low frequency effects, and I kind of tied them to volatility regimes. We're going to allow for that in the model, and we are going to generate similar type of low frequency effects from these volatility regimes. Okay. Now, I've talked about this model, but what are we doing here? We're going to build a DSGE model with endogenous supply of equity and bonds. We're going to have a production economy in which non-financial firms decide how much equity and debt to issue. The key aspects in driving this financial decision is there are two components. On the equity side, firms want to smooth dividends. On the debt side, these firms are going to face some credit frictions. In particular, they're going to face a marginal cost of borrowing that's increasing in debt. Okay. We know that we need to do something so that Modigliani-Miller result fails to talk about a meaningful decision, capital structure decision. This is what we do here. Now, we propose uncertainty as being an important role in explaining these facts. Different than the standard literature, which talks about uncertainty just in terms of risk, but very much within the scope of this conference. We allow for uncertainty to also, we model it also as 90 uncertainty or ambiguity. We think this is important because 90 uncertainty is going to allow us to talk about an agent involved in this financing decision that is not fully confident in probability assessments. And then once we open up this uncertainty to have these two channels, then if we allow uncertainty to be time varying, we can now talk about shocks to volatility, which are the usual shocks in the literature. Our volatility shocks are going to take the form of regime switching volatility. And then we're also going to have these shocks to ambiguity, these pure, independent confidence shocks that are going to affect how confident this agent is in his probability assessments. Okay. So we build this model with these main ingredients. We solve it, and then we want to take it to the data. Okay, we want to estimate this model. The data we're going to use is US data from standards and relatively standard observables, such as NIPA and flown funds. And what we think it's an advantage of our strategy is that we can estimate the model using standard Bayesian likelihood techniques. And that's made tractable because we're going to solve the model using a first-order approximation, which means that we can use standard Kalman filter techniques to estimate this model. Okay, so I'm going to detail how we do that. So in terms of literature, talking about ambiguity, we build on this decision theory. In particular, we're going to use this multiple priors utility in the static Gilboa-Meidler recursive Epstein-Schneider. We talk about business cycles, asset pricing, asset supply, and uncertainty. So these are things that, of course, there's a wide literature on it. So just very selectively here, I mentioned some work that looks at a production economy, asset prices, and risk shocks, the standard volatility shocks, and then some other work that looks at robustness to capture this ambiguity and this 90 uncertainty. Okay, but most of these papers kind of ignore the asset supply side of it. There is a literature that does that, but that literature tends to ignore the asset price implications of that. Okay? So let me talk about preferences very, very briefly, given this audience. So we want to capture here ambiguity aversion. We're going to have a state space, capital S. One element is realized every period. We have a history. We have a consumption stream. That's a function of that history. And then we want to study how does an agent evaluate such a consumption stream following a history of events. The recursive multiple priors utility instructs this agent to think about this consumption stream as the per period utility function out of that, and then the expected discounted continuation utility, where the expectation is taken under a probability distribution that minimizes this expected continuation utility over a set of distributions. Okay, so this is well known. Now, it's important, just for future references to keep in mind what are the primitives here. Okay, the primitives are the standard felicity function, discount factor, and of course, this one step ahead belief set is part of the primitive. This can be time varying. It can be a function of this sequence of events. Okay? Now, as you are familiar with this multiple priors model, when this set of distribution is larger, this captures the notion that this agent is now less confident in probability assessments. Or on the contrary, when the set is smaller, this agent is more confident. And of course, in the limit, when this set is singleton, this guy becomes expected utility being fully confident in that probability distribution. But we're going to play quite a lot on this set, and we're going to allow for time variation in this set. So we specialize here this one step ahead belief set to be about the mean innovation for a shock. Okay, we're going to write a DSGE model, which in general is going to produce a history of events given by the history of innovations to exogenous shocks. And then we allow this agent to be ambiguous about the shocks inside this model. The way we represent that one step ahead belief set that entered in that recursive multiple prior here is in the following way. Take a shock. Here I denote this by xi, so it's a particular shock indexed by I. So this representation says that you're sitting at time t. The way this agent thinks about the future shock is that it's a sum of partly an AR1 component. This is sort of conditional on the state today. Then there's an innovation tomorrow. This innovation here is risky, which means that this distribution is well understood. Here it's a normal with standard deviation sigma t. And then there's a part that's ambiguous that affects this one step ahead conditional mean. Okay? This mu is what here ambiguity is going to be about. So the way we capture that ambiguity is to say, well, this component that I'm not sure about lives in a set. Okay, it's going to belong to a set minus a plus a. And anything inside that set can be with probability 1, the true data generating process. Okay, so this is the multiple priors utility. Now, here you see again this notion that what is more ambiguity is, or less confidence is when this set is widening. Okay, so the stochastic process for this A is going to regulate the size of this. For example, a larger A just means a larger set, less confidence about my belief for the shock tomorrow. Okay. Now, remember the multiple priors utility says you are given this set. This is part of your primitives. How do you form expectations is as if the true data generating process is the worst case distribution. In this case, because ambiguity is about the means, the mean operator selects the worst case mean. Now, what is the worst case mean? It's important. It's endogenous to the problem. It's endogenous to the type of shock. It's endogenous to the type of decision that this agent makes. Okay? Endogenous in the sense that, for example, if this ambiguity is about the productivity type shock, the worst case is that productivity tomorrow is going to be low. If this is about the cost, for example, a cost type shock, the worst case is that the cost tomorrow is going to be high. Okay, so it's one of these bounds, but the sign depends on the action and on the type of the shock. Of course, here, once you establish that the mean operator selects the worst case mean, then an increase in ambiguity, for example, if the worst case mean is minus a, an increase in ambiguity means that this agent is going to act as if tomorrow's mean of this x is lower. Okay? It's as if you receive some bad news about tomorrow. Here I'm writing again this representation for clarity. And I can now talk about how do we think about this time variation in the size of this set. Okay. We're going to allow for two sources of shocks that affect this ambiguity. Okay. And the way we think about that is to link ambiguity, this width of this set, to stochastic volatility, to the sigma t, with a coefficient that's potentially time varying too. Okay, so these are going to be our two sources of shocks that are going to affect ambiguity. You might wonder, how do we make up this? I think it's a sensible sort of functional form, if you like. But this actually, you can show this derives more formally if this set of conditional distributions is the relative entropy ball. Okay, we have a set. So now it says the set is such that the relative entropy ball of elements inside the set of distribution is bounded by some coefficient. Okay, and we allow that coefficient to vary over time. Now, once we write these possible sources of ambiguity, we are able to talk about these two sources of shocks that affect it. One is this size, if you like, of this entropy, relative entropy ball. The way we think about this is a type of intangible information that affects confidence of the agent. For example, this eta can go up. It can follow, let's say, an AR1 fashion with some steady state. An innovation, a positive innovation here says that this agent is more ambiguous or less confident in his assessments about future X. But at the same time, we also allow, because of the way we write this linear in standard deviation, we allow for volatility shocks, in particular here in forms of regime switching. And the way intuitively you can think of this is that volatility here, an increase in volatility, lowers confidence. Okay, you observe turbulence. This makes you less confident in the in your probability assessments. Okay. One methodological advantage we get out of this is that we're going to get this first order effects of changes in volatility because it affects ambiguity and because this affects the first order my expectations about the future. So at this stage, I described this evolution of confidence. I don't necessarily need to talk here about the true data generating process because it doesn't show up in the preference representation. But still later, when I'm going to talk about how to solve the model, what are the empirical implications, what an econometrician measures, and so forth, I have to take a stand on what some type of true data generating process is. This is related to discussions that we've heard also this morning. The way we think about this is that we allow an agent to be concerned for non-stationarity in this data. And the way we do that is to say, well, actually, the true data generating process is such that this mu there's a deterministic sequence that you can think of it being drawn at the beginning of time. It's a deterministic sequence whose moments, or with moments converging to some normal with mean 0 and some volatility. Okay? But importantly, we put the agents and the econometrician on the same footing in the sense that neither agents nor econometrician can identify the true sequence. Okay? So I've talked about the ambiguity part, described preferences. I described how ambiguity moves through time. Let me talk about the meat of the model, but in a relatively concise way. Okay, so here's the model overview. We're going to have a production economy. The way we're going to do that is build on a standard RBC-style model with a representative agent and representative firm. For asset pricing, it's important to capture this ambiguity to generate this excess return predictability. So for that, we're going to have this representative household maximize this recursive multiple priors utility that I described before. But otherwise, this household is standard in the sense that it works for wages, holds bonds, holds stocks, pays taxes, potentially receives some endowment. So that's the household side. On the firm side, we have a representative firm that maximizes shareholder value. Of course, when it does so, it's under the stochastic discount factor of the household. So those worst case conditional probabilities are going to show up in the firm decision. And here we are interested in generating some meaningful capital structure decision, which means that we're going to have to break the Modigliani-Miller result. So we're going to have adjustment costs for net payout to shareholders, and we're going to have credit frictions in the form of this firm. When it thinks about how much it can borrow, the marginal cost of borrowing is going to be increasing in the debt level. It's a reduced form to capture some micro-founded optimal contract type of framework. So the margins for the firms are, because it's a production economy, investment, labor, and then on the asset supply, it's going to be this net payout decision and debt. To close the model, we're going to this is going to be a competitive market economy. In the goods we have, which is consumption good, in the assets, equity, and one-period bonds. Now, the shocks we allow in this model are the following. We have relatively standard shocks on the production, so TFP growth, and on the demand side, if you want, government spending. Because we introduce these credit frictions, we also borrow some intuition, some elements from papers like Ehrman and Quadrini and so forth, and think about shocks to the financial conditions that this firm is facing. So there we're going to have two shocks. One is one that affects marginal decisions, the marginal cost of borrowing, and one that is just a fixed cost of accessing this credit market. And then this agent is going to be ambiguous about all these four shocks. You can think of it as structural shocks, let's say. This agent is going to be ambiguous about these shocks. And ambiguity is going to have these two sources that I talked about. It's going to be volatility, which is going to be this common regime switching. When volatility is high, volatility of all these shocks is high. And then also this independent confidence shocks of how it affects how confident this agent is in probability assessments about a particular shock. So we're going to have here a bunch of ambiguity shocks, and the common regime switching volatility. Now, I could write down in more detail the model with many equations, but I think it is useful to understand the intuition on the two main things that we want to highlight, which is the asset supply decision and the asset pricing decision. In the paper we have also a small model that we can generate a lot of closed form solutions to see this intuition. Here I'm going to talk through some of that. We want to understand here firm financing decision. What is the objective of a firm in this model? It's to maximize the present value of net payout under the state prices. And these state prices are going to inherit the worst case conditional probabilities out of the household. What is the payout? For that you look at the firm budget constraint. The payout is net income. So think about here in the RBC model is a production function. You pay wages, you pay for some investment adjustment costs, you pay taxes. So anything that's coming on the production income side. So this is net income. Then this firm also has a choice over debt. So it can decide to change its debt stock, its stock of debt. And then it faces these costs that are going to be important in generate meaningful decisions on this capital structure. There are going to be these borrowing costs, a function of the stock of debt. There's going to be dividend adjustment costs that are going to be useful to incentivize this firm to smooth dividends. Okay? Again, it's a reduced form. I view this as reduced form, functional forms, reduced form thinking of underlying optimal contract problems. The key inputs in this in this optimization are the following. Expectations are under the worst case conditional probability. So when this firm decides about the future payout, it takes into account this. And these dividend adjustment costs generate an incentive to smooth dividends, and we have financing costs. To understand, I think, the intuition, it is helpful to look at the decision of this firm with respect to bonds that it decides to issue. And here, I think you'll find this quite intuitive, that the firm is going to issue more debt if expected dividend growth is high. Okay? The logic is very similar to an Euler equation for a household. If the household expects consumption growth to be high, it would like to borrow and increase consumption today to smooth this this consumption path. Okay? The same way here, a firm that receives some news that dividend growth is going to be higher would like to increase debt today so that it increases dividends and makes now this dividend profile smoother. Okay? So now once you take this first order condition in consideration together with a budget constraint that I wrote here, you can see already you get interesting implications about the co-movement between dividends and debt. And this was the objective I set up in my stylized facts. How is this co-movement looking for different types of shocks? For standard shocks, which you can think of profit shocks, for example, productivity shocks, this co-movement will be negative in the following sense. When you have, let's say, a productivity shock that increases your income today, in equilibrium you're going to pay some dividends today, but because of the mean reversion as property of this shock, tomorrow you're going to pay less dividends. Okay, so then the dividend growth is going to be negative, and because of this property I set up here, you're going to issue less debt. Okay. Now this means that with these profit shocks, you're going to pay out more, but issue less debt. So you get a negative co-movement between dividends and debt. Well, the opposite happens if you have uncertainty shocks. Imagine the following situation. Imagine that uncertainty is low about future productivity. Okay? This means that here this firm takes expectation with respect to this worst case conditional probability, which means here that if uncertainty is low, it's as if this firm receives some good news about the future in terms of productivity. In equilibrium, it understands that it's going to pay out more in the future. So now this dividend growth becomes positive if it doesn't do anything today. I've established this property that is the firms are going to issue more debt to smooth out now this profile. Okay? So now this firm is going to, having this low uncertainty, is going to pay out more dividends and issue more debt to smooth out this profile. And this is what generates this positive co-movement. So now this already is what we find interesting, that these uncertainty shocks, I've told you that we think they play an important role in understanding financing decision. You see here that qualitatively, this is a type of shock that generates the positive co-movement that we see in the data between dividends and debt. But the other aspect of what we want to get to is asset pricing. So for here, again, I think it's useful to look directly at the log linear Euler equation of a household that decides how much stock to hold. This is the usual Euler equation. Price is the stochastic discount factor, expected price, expected dividends, where, of course, expectations are taken under the worst case conditional probabilities. Now put in an econometrician here and let him measure excess returns. Let's define excess returns is realized price plus realized dividend minus realized price yesterday minus the interest rate. But we know what prices are in equilibrium, or just these expectations. So then the excess return is nothing else but the difference between realized prices and expected prices plus the difference between realized dividends and expected dividends, where those expectations are under the worst case conditional probabilities. So now when an econometrician looks at this object and he tries to measure it, of course, what he's going to observe is data generated by the true process. So he's going to measure some excess return, which is going to be the average excess return under this true process. Okay, let's denote that by ET. Now, we see here that these excess returns are going to be a function of the worst case conditional probabilities. So an econometrician that measures this is going to capture some excess return that's going to fluctuate through time. This excess return are going to reflect the difference between the true data generating process and the worst case conditional probability. And there's nothing else than just some uncertainty premium that this household requires in equilibrium to invest in these stocks. Okay? In particular, the way that these excess returns are going to move is that when there's lower confidence, okay, which means that this agent thinks that tomorrow's prices, tomorrow's dividends are going to be low, then this econometrician is going to measure higher premia. Okay? So this is the sense in which we get this excess return predictability based on confidence shocks. Unconditionally, this was a conditional statement. Unconditionally, you're going to find a similar logic. We're going to find positive average equity premium. Okay? And the reason is there are going to be two channels, which are the usual two channels to think about equity premium. One is that the stock return is going to be high, this part. The stock return is going to be higher under the true data generating process or under the econometrician law of motion than under the worst case probability distribution. And at the same time, the interest rate is lower, because we have to take into account here, the interest rate is lower because of this ambiguity in the steady state. And what's interesting is that the size of this effect depends on how important is ambiguity for consumption growth. Okay? So we know that in steady state, this agent will expect some low consumption growth, some negative consumption growth. That's why the interest rate is going to be low. But if ambiguity is about financial conditions, about this, let's say, borrowing cost that affects dividends, and dividends are just a small part of my consumption, which they are also in the data, then this ambiguity about financial conditions will affect only a little bit the consumption growth. Okay? This effect will be small, so the interest rate effects will also be small. So that means that the average equity premium we're going to get is going to be coming mostly from the stock return and not from the interest rate, which we find is an interesting result. Okay? The way we solve this model, I'm going to skip a little bit some details here, but we build on some previous work. The solution comes in two steps. We first find the recursive equilibrium, then you characterize variables under the econometrician law of motion. The way we find this recursive equilibrium is a guess and verify approach. You first guess the worst case belief, then you solve the model as if it's an expected utility under that worst case belief, and then you verify that that guess indeed achieves the minimum. And then what's nice is that at this step of solving the model as its expected utility and this belief, you can use standard solution methods, as for example the first order approximation. Okay, so we're going to be able to write the DSGE solution, for example, as a Markov switching VAR, where this constant, this time varying constant, is going to come from the first order effects of volatility regimes. So we're going to take this to the data and apply Kalman filter techniques. Okay, but it was important that we were able to get this linear and use standard likelihood methods. This is what we do. The estimation is we estimate this law of motion together with an observation equation. We use data. If you like, I can talk later about how we identify ambiguity shocks and volatility shocks. Let me move to some results and the data. We're going to use 8 series, so macro aggregates, growth rate of output, consumption, investment. We're going to use asset prices, the value of equity, interest rate, and interest rate spread. We're going to use data on asset supply. Okay? And here is some results that we're going to find. So this is the smooth probability of the high volatility regime. You see it occurs almost exactly in that period that I shaded as the blue area. Okay, so this is the high volatility we recover. What are the effects on prices? Here is I'm feeding in this regime sequence, low volatility, high volatility. You see it has very large effects on prices. This is like a 20% drop, okay, very large effects on prices. How do we explain the time path of stock price? This is the green line. We explain it we explain significant fraction of it with this shock, which is ambiguity, this confidence about the financial conditions. Okay? The low frequency was from volatility regimes. The other frequency comes from these confidence shocks. And finally, to show you just some nice colors, let me show you a spectral decomposition to see what shocks are important in this model. Conditional regime, you see here these warm colors are ambiguity shocks. You see that ambiguity about financial conditions are very important for dividends and for stock prices, and much less important for quantities. Okay? So to conclude, we build this DSGE model to study endogenous asset supply. We are interested in seeing how uncertainty may explain simultaneously dynamics in asset supply and asset pricing. We take the model to the data and have a quantitative approach to this exercise. Thank you.